In this video, we are going to talk about refinance mortgage options. So before starting, please like this video and subscribe to this channel for future updates. When you refinance a mortgage, you are essentially replacing your current mortgage with a new loan with new conditions that better suit your financial goals. Choosing whether or not to refinance your mortgage is a big choice, but it doesn't have to be difficult. Refinancing may be able to cut your monthly payments, shorten the duration of your loan, or transfer you into a more secure loan if you have a high interest rate mortgage, an adjustable rate loan, or if your payments are becoming unmanageable. Traditional refinance. You may be able to refinance your mortgage if you simply want to make your payments more manageable and your house value has remained stable or increased. Similar to when you received your first mortgage, you'll go through an application, approval, and closing procedure. Your mortgage provider will work with you every step of the way, assisting you in determining the best mortgage option for your circumstances. I'm up to date on my mortgage, but I'd like to reduce my monthly payment. Fannie Mae collaborates with tens of thousands of lenders to provide a wide range of refinancing choices. Contact your current mortgage lender, whether it's a bank, credit union, or another institution. Cash out refinance. Some mortgages allow for a cash out refinance, which allows you to cash out some of your home equity. The money you take out in cash will be added to your mortgage loan's total balance. This can diminish the amount of equity in your house, lengthen the time it takes to pay off your mortgage, and cause you to pay more total interest in the end. While there are times when this alternative makes sense, it's something you'll want to think about carefully before proceeding. A cash out refinance involves getting a new, larger mortgage loan to pay off your old one. After paying off your original mortgage, the money left over is paid to you in the form of a check at closing. This is the cash out part of the equation. Here's how a cash out refinance works in practice. The house is worth $350,000. $250,000 is the current mortgage balance. Balance of refinanced loan, $280,000. Cash out at the end of the transaction, $30,000, minus closing costs. The new loan must first be utilized to pay off the existing mortgage in the case above. The remaining loan amount $30,000 is the amount you're withdrawing. On a cash out refinance, you'll additionally have to pay closing costs, which are typically 3 to 5% of the loan amount. The good news is that you can roll closing expenses into your loan balance instead of paying them upfront when you refinance. However, including closing fees in your loan means you'll have to pay interest on them over time. So think about the long-term implications before doing so. What is a mortgage rate? The interest rate on a mortgage is known as the mortgage rate. Mortgage rates are set by the lender and can be fixed or variable, with the latter fluctuating with a benchmark interest rate over the length of the loan. Mortgage rates fluctuate depending on a borrower's credit history. Mortgage rate averages fluctuate with interest rate cycles and can have a significant impact on the home buying market. Understanding mortgage rates. For homebuyers planning to finance a new house with a mortgage loan, the mortgage rate is a major factor to consider. Collateral, principal, interest, taxes, and insurance are all issues to consider. A mortgage's collateral is the house itself, and the principal is the loan's initial amount. Taxes and insurance are calculated based on the home's location and are normally an estimate until the time of purchase. Determining a mortgage rate. When a lender grants a mortgage, it assumes some risk because there is always the possibility that a consumer will default on his debt. The mortgage rate is determined by a number of criteria. With the bigger the risk, the higher the rate. In the event that the borrower defaults, a high rate assures that the lender recoups the initial loan amount at a faster rate. Protecting the lender's financial investment. The credit score of a borrower is an important factor in determining the interest rate charged on a mortgage and the size of the mortgage loan that can be obtained. A better credit score implies that the borrower has an excellent credit history and is more likely to pay back his debts. Because the danger of default is reduced, the lender can cut the mortgage rate. The interest rate charged ultimately influences the total cost of the loan as well as the monthly payment amount. As a result, borrowers should constantly aim for the lowest available rate. Reverse mortgage. You might consider a reverse mortgage if you're 62 or older and need money to pay off your mortgage, augment your income, or cover healthcare costs. It allows you to convert a portion of your home's equity into cash without having to sell it or incur additional monthly expenses. Take your time, though. A reverse mortgage can be complicated, and it may not be the best option for you. A reverse mortgage can deplete the equity in your house, leaving you and your heirs with fewer assets. If you do decide to look for one, learn about the many types of reverse mortgages and compare lenders before settling on one. How do reverse mortgages work? When you have a standard mortgage, you make monthly payments to the lender in order to purchase your property over time. A reverse mortgage is a loan where the lender pays you back. Reverse mortgages turn a portion of your house's equity into payments to you, thereby acting as an advance payment on your home equity. Usually, the money you get is tax-free. In most cases, you are not required to repay the money for as long as you dwell in your house. You, your spouse, or your estate would return the loan when you die, sell your home, or move out. It may be necessary to sell the home in order to repay the debt. Single-purpose reverse mortgages, which are offered by some state and local government agencies as well as nonprofits. Proprietary reverse mortgages, which are private loans, and federally insured reverse mortgages, also known as home equity conversion mortgages, are the three types of reverse mortgages, HECMs. When you take out a reverse mortgage of any form, you're taking out a debt against the value of your property. Your home's title is yours to maintain. Instead of making monthly mortgage payments, you receive a lump sum payment on a portion of your home equity. The money you get is normally tax-free, and it has no impact on your Social Security or Medicare benefits. The debt must be repaid when the last remaining borrower dies, sells the home, or no longer lives in it as a primary residence. A non-borrowing spouse may be able to stay in the house under certain circumstances. Home equity loans. If you're planning some home improvements or searching for a means to pay for your child's college education, you might consider using your house's equity, the difference between what your home is worth and what you owe on the mortgage, to cover the expenditures. A loan or a line of credit might be used for home equity financing. A home equity loan gives you the entire loan amount up front, whereas a home equity credit line gives you access to cash whenever you need them. Shop around and evaluate loan programs offered by banks, savings and loans, credit unions, and mortgage companies when considering a home equity loan or credit line. Shopping can assist you in obtaining a better deal. Remember that the amount you borrow through a home equity loan or line of credit is secured by your home. If you don't pay your loan, your lender may be able to forcibly sell your home to pay it off. Home equity lines of credit. A HELOC, home equity line of credit, is a revolving line of credit that works similarly to a credit card. By writing a check or using a credit card linked to the account, you can borrow as much as you need, whenever you need it. You are not permitted to exceed your credit limit. Because a HELOC is a line of credit, you only pay interest on the amount you borrow, not the entire balance. HELOCs may also provide you with tax benefits not accessible with other types of loans. For more information, see an accountant or tax advisor. HELOCs, like home equity loans, require you to use your home as security. If you miss a payment or can't make a payment at all, this could put your home in jeopardy. Loans with a hefty balloon payment, a one-time payment due at the end of the term, may force you to borrow extra money to pay off the debt, or they may put your house in peril if you can't refinance. Furthermore, most plans require you to pay off your credit line at the same time as you sell your house. What do you think about our video? Let us know in the comment box below. Please like this video and subscribe to this channel for our future updates. Thank you.